Been a lot of concern lately about things seen in the sky, justifiably so, but quite honestly, I'm almost just as concerned about the things I'm seeing in the land and sea. There's also been a lot of talk lately about how the rich are using life insurance to avoid taxes for themselves and their heirs. But see, it's not just the rich that can use life insurance as tax avoidance plans. So while we clean up this mess, let's talk about the Secure Act 2.0. See, prior to 2022, when citizens would pass away and leave their qualified retirement plans to their family or close relatives, those beneficiaries who received that money would have pretty much the rest of their lives to access and withdraw those accounts as needed. And oftentimes they pick and choose when to use those inheritances because even though it's not their qualified retirement plan, government still wants their income tax money on it. Of course, as we know, qualified retirement plans like 401ks, 403bs, IRAs, SEPs, you name it, all grow tax deferred. The IRS wasn't just going to give up that money, and in fact, the Secure Act 2.0 sped up this whole process. Since that legislation, those who receive qualified retirement accounts as an inheritance now have 10 years to use that money. And if it's not a person at all, maybe a charity or a trust, they have 5 years. That's because the IRS wants their income tax money quicker. So in steps life insurance. If you have a qualified retirement account that you know you're not going to likely access or need to access, and plan on the majority of it to be left to your heirs, people are starting to take distributions out of their qualified retirement plan and use that to fund a life insurance policy, usually of greater death benefit. This allows the plan participant to pay those income taxes before they get left to their family, who then would have to pay it on their behalf, and increases the total benefit of which the heirs can inherit. And because that benefit is structured under a life insurance policy, it's totally income tax free. Now, life insurance policies are income tax free, but they're not estate tax free. So if that plan participant expects estate taxes to be due by their heirs, they can do something many other wealthy do, which is place that life insurance policy into an irrevocable trust. This disinvests the ownership from the plan, which means it's no longer part of the estate, which means nobody has to pay estate taxes, and the benefits get left to the trust that's controlled by the heirs.